Roger Montgomery and welcome to this week's Video Insight. We've recently sent our annual letters to our investors, so in this week's update I'm providing an update on how the Montgomery Fund is performing. The 12 months to 30th of June 2018 were good to Australian equities. The S&P ASX 300 Accumulation Index returned a solid 13.2% for the year. Similarly, the Montgomery Fund had a positive year, and while it didn't keep pace with the broad market, it did return 9.3% for the 12 months, with a very heavy weighting to cash, which of course returns very little. While the fund didn't match the returns delivered by the benchmark, we were generally happy with the stock selection for the year, with the equity component of the portfolio delivering a satisfactory return. One of the fund's goals is to outperform the broader market over long stretches of time, but another, perhaps more important goal for the fund is to preserve investor capital, and the gap between the fund's performance and that of its benchmark in 2018 was very much a function of our unwillingness to take on high levels of risk in a market that has climbed steadily for an extended period. That market now offers relatively few opportunities for value-conscious investors. Now, our focus, as always, is on longer-term measures of success, which include not only investment returns, but also the level of risk taken in pursuit of those returns. Pleasingly, since its inception, the Montgomery Fund has delivered better returns than the broader market, and it's done so with smaller drawdowns and lower volatility. It's also done it with a very high average weighting to cash. Over longer stretches of time, we expect that returns from the fund should be driven by the success of its philosophy and stock selection methodology. Now, for quite some time, the fund has held a significant amount of its asset value in the safety of cash, and that reflects our view that valuations generally have been stretched. In fact, the best performing stocks recently have been those that were already generally the most expensive. It almost seems as though a basic tenet of investing has been broken. The higher the price you pay, it seems, the better your return. A quick look at the cash balance of Berkshire Hathaway in this chart reveals $118 billion in cash, or 23% of the company's market capitalisation. Put another way, Buffett and his team could have purchased outright any of the lower 450 companies in the S&P 500, and yet they bought none. Clearly, they also believe valuations were a barrier to acquisition. For Montgomery, our cash allocation acts as a drag on performance while equities continue to run strongly, but it does provide protection and optionality in the event of a downturn. We expect that when a downturn does arrive, preservation of capital will very much be front of mind for many investors. Of course, we have no reliable way of predicting when such a downturn might happen. But we know a fundamental truth. The higher the price paid for an asset, the lower the long-run returns to the investor must be. Accordingly, as asset prices rise, so too does our willingness to hold cash. Since the depths of the GFC in early 2009, Australian equities have marched higher at a more or less steady rate, with most of the gains due to expanding multiples rather than growing earnings. And that's important to remember. There's no limit, of course, to how long this process can continue, but paradoxically, it can't continue forever. We expect the Montgomery Fund will achieve a reasonable measure of capital protection and outperform the broader equity market if market conditions turn negative. Surplus cash will, of course, find its way into attractive opportunities as and when they appear. Thank you for watching today, and we look forward to your comments. Make sure you continue to follow us on Facebook and Twitter to stay up to date, and I look forward to speaking with you next week.